Hello students. So now we have progressed a lot in the lecture of amalgamation. Okay, we have covered the accounting in the books of transferor and transferee company both. But so far we have seen only the questions on merger. Okay, amalgamation in the nature of merger and pooling of interest method based accounting. Now today we take one step further. Okay, moreover we have seen only lump sum method of purchase consideration so far. So today's question is going to be very comprehensive. It may be required that you all pause the video, rewind it and listen to the things again and again. Okay, there's a good practice. So when you're watching the lecture, if you don't understand anything, then don't get afraid. Pause the video, rewind it again and listen to that explanation once again. If you listen that maybe 2 or 3 times, you'll understand the things exactly. So look at the things, everyone, be attentive. Take out question number 6 of your study material. Okay. A Limited and B Limited were amalgamated on 31st March 2019. A company C Limited was formed to take over the business of existing companies. So A Limited and B Limited, old companies which are going into liquidation, they are transferor companies, marked as OR, transferor companies. Okay. And C Limited, the new company which is formed, marked as transferee company. Okay, that's a transferee company. Now, further, their balance sheet as on 31st March 2019 was as follows. Equity share capital rupees 100 each, fully paid up 16 lakhs and 15 lakhs. So what would be the number of shares in Alpha Limited and Beta Limited? Okay, here A Limited and B Limited, in fact, make the correction. It should be simply A Limited and B Limited. Okay, no Alpha and Beta. Maybe the question was copied and pasted from the previous one, so it had come Alpha and Beta. Make it A Limited and B Limited, simply A and B. So A Limited 16 lakhs divided by 100. How many equity shares would be there? 16,000 equity shares would be there. And B Limited 15 lakhs divided by 100. How many equity shares would be there? 15,000 equity shares would be there. Okay. I repeat, 16 lakhs divided by 100. 16,000 equity shares in A Limited and 15 lakhs divided by 100. 15,000 equity shares in B Limited. 12% preference shares of 100 each, 6 lakhs. Exactly same way. 6 lakhs divided by 100. So 6,000 equity shares, preference shares in A Limited, and 4 lakhs divided by 100. So 4,000 preference shares in B Limited. I hope everyone is clear with that. General reserve 6,40,000 and 5 lakhs. Export profit reserve. Now export profit reserve is generally a statutory reserve. Statutory means compulsory reserve to be maintained. You all can refer to the past lectures and I have explained you the point regarding statutory reserve, that if it is amalgamation in the nature of merger, then as such we take all the reserves, so no problem. But if it is amalgamation in the nature of purchase, then liabilities don't include reserves, but statutory reserves are taken over by passing a separate journal entry, amalgamation adjustment account debit to statutory reserve account. I advise you all can refer to those past lectures and summary again before you go through further in this lecture. Profit and loss account 1,60,000. 10% debentures of 100 each, 1,20,000 and 60,000. So 1,20,000 divided by 100. 1,200 debentures would be there in A Limited and 60,000 divided by 100. 600 debentures would be there in B Limited. Sundry creditors 8,40,000 and 3,80,000. Land and building, plant and machinery, investment, stock, debtors, cash and bank. Now, first adjustment. 10% debenture holders of A Limited and B Limited are discharged by C Limited by issuing such number of its 15% debentures of 100 each so as to maintain the same amount of interest. Now underline 10% debentures. They are discharged by 15% debentures, means old company A and B Limited debenture holders were getting 10% interest, but in the new company C Limited, the same debenture holders will get 15% interest. Okay, Further, they are to be discharged by issuing such number so as to maintain the same amount of interest. This we will see exactly in detail when we take up with the workings, etc. Okay, but right now you all can underline this. 10% debentures are discharged by 15% debentures. And what number of debentures will be given? The number of debentures will be given in a way where they maintain the same amount of interest. Means in A limited and B limited, whatever interest they are earning, same interest they will be earning in C limited also. Preference shareholders of two companies are issued equivalent number of 15% preference shares of C limited at a price of rupees 150 per share. Face value is rupees 100. First of all of you underline issued equivalent number. Now if you all see here, we have already written, that's why there are 6,000 preference shares in A limited and 4,000 preference shares in B limited. Equivalent number means A limited will get 6,000 equity shares and B limited will get 4,000 equity shares. Same equity shares. Preference shares. Preference shares. Okay. Equivalent number means A limited will be issued 6,000 preference shares and B limited will be issued 4,000 preference shares. But 15%. In the old companies, they have 12% preference shares. But in the new company, they will be issued 15% preference shares. And again at a price of rupees 150 per share. Again face value is 100, means you can say that 50 is security premium. Okay. Agreed value is 150 of the same shares. Face value is 100, means the preference shares are going to be given to the liquidator of transferor companies at 50 rupees premium. All this we'll see in workings in details. C limited will issue 5 equity shares for each equity share of A limited and 4 equity shares for each equity share of B limited. Okay, just underline it, then we will see the things in detail when we make the workings. The shares are to be issued at rupees, again underline, 30 each, having a face value of rupees 10 per share. So here also you can say that 20 rupees is premium. Okay, face value 10 but issued at rupees 30 means 20 rupees is premium. Export profit reserve is to be maintained for next 5 years. This indicates that it is a statutory reserve. You have to maintain it for the next 5 years, means it's compulsory to be maintained even after amalgamation. So it's a statutory reserve. Calculate purchase consideration. Obviously, before you pass the entries, even if not asked in the question, we have to first find purchase consideration. Pass necessary journal entries in the books of C limited, means transferee companies accounting is asked. And also prepare balance sheet of C limited after amalgamation. So in this question, accounting entries are asked in the books of which company? Transferee company. Now if you all remember, I told you in earlier questions also that 3 things you have to identify in every question. Very first, is it amalgamation in the nature of merger or purchase? Okay. Second, you have to identify the method of purchase consideration. In every question you have to do this. And third, if it is amalgamation in the nature of merger and accounting entries are asked in the books of transferee company, then we shall follow pooling of interest method of accounting. And if it is amalgamation in the nature of purchase, then in the books of transferee company we shall follow purchase method of accounting. So 3 things we have to identify in every question. Okay. Now, before we proceed further, very first we will make workings of debentures. Then only we will be able to understand whether it is merger or purchase. So let us first do that. Okay. All of you make format of journal entries in the books of C limited what is asked, or you can leave around 1.5 page for that. And then we first make the working notes. Okay. First we make the working notes especially of debentures. and then we come back to the 3 points what we discussed. So that complicated language of debentures will also be clear. First working of debentures. Now I am doing it for A Limited, and all of you pause the video and do it on your own for B Limited, and then you verify after playing the video whether you have done it right or not. So see what information is given in adjustment 1. 10% debenture holders of A Limited and B Limited are discharged by C Limited by issuing such number of its 15% debentures of 100 each, so as to maintain the same amount of interest. Now main point I made you underline, so as to maintain the same amount of interest means in the new company C Limited also the debenture holders must earn same amount of interest. So let's first find what is the interest they are earning. 1,20,000 are debentures in A Limited and rate of interest is 10%. So presently in A Limited, what is the interest debenture holders are earning? Write down. The interest what they are earning is, interest is equal to 1,20,000 are the debentures in A Limited into rate of interest is 10%, so 12,000. Presently in A Limited, what is the amount of interest debenture holders are earning? 12,000. See that again. 1,20,000 is the value of debentures, 10% is the rate of interest. So presently in A Limited, debenture holders are earning what amount of interest? 1,20,000 into 10%, 12,000. What is the condition given in adjustment 1? So as to maintain the same amount of interest. Means in the new company also, debenture holders must earn same interest of 12,000. In the new company also, debenture holders must earn same interest of 12,000. But in the new company now, are they going to get 10% rate of interest? No. In the new company, they are going to get what rate of interest? 15%. Even at 15% interest in the new company, they must get the amount of 12,000 interest only. So how is that possible? Let's work it out. See, interest and face value. Make two columns. Interest and face value. When interest is 10%, face value is 100. Okay, rate of interest is 10%, means on face value of 100 you earn 10% interest in the new company, old company. Now in the new company, instead of 10%, you are going to get 15% interest. Old company they were earning 10%, but in the new company they are going to get 15% interest. Okay, as you can see here, 15% debentures of C Limited. So in the new company, if they are earning 15 rupees of interest, their face value is 100. Now they want to earn same interest of 12,000 rupees. So if they want to earn interest of 12,000 rupees, then what should be the face value? At the rate of 15%, if they want to earn 12,000 rupees, then what should be the face value? 12,000 into 100 divided by 15. Okay, now 12,000 into 100, if you do it, then it will come to, yeah, face value is same 100, right? 12,000 into 100 divided by 15 will come to 80,000. Check it up everyone in the calculator. 12,000 into 100, that is 12 lakhs. 12 lakhs divided by 15, 80,000. So what should be the face value of debenture in the new company? It should be 80,000 rupees. Then only the debenture holders will earn 12,000 interest. Okay, in the new company they are going to get 15% debentures. Cross check. If the face value is 80,000, then 80,000 into 15% interest. All of you cross check. 80,000 into 15% interest. Do they still earn 12,000 rupees in the new company also or not? So if the new company C Limited gives debentures of rupees 80,000 to the debenture holders of A Limited, but at the rate of 15% interest, then A Limited's debenture holders will continue to get 12,000 interest. Okay, so what is this 80,000? It is the agreed value of debentures. It is the agreed value of A Limited's debentures. In the old company, they had 1,20,000 of debentures. But in the new company, they are going to get only 80,000 of debentures. But even after getting only 80,000 of debentures, they are going to earn 15% interest. So interest amount is going to remain same. Okay. So C Limited is taking over the debenture of A Limited. But at what agreed value? 80,000 rupees. I repeat, C Limited is taking over the debenture of A Limited, but at what agreed value? 80,000 rupees. Now, in the same manner, all of you pause the video and work out for B Limited on your own, and then you play the video and you verify you have done it right or not. Okay? See, in B Limited now, debentures are 60,000, rate of interest 10%. So what is the interest right now the debenture holders are getting in B Limited? They are earning interest of 60,000 into 10%, that is 6,000. Okay, in the new B Limited, right now the debenture holders are earning interest of 6,000. Now in the new company, they will be getting interest at the rate of 15%. So when interest of 15 rupees is received, then the face value would be 100 rupees. If they want to continue receiving 6,000 of interest, then what should be the face value of debentures given to them? 6,000 into 100 divided by 15. Now here it comes to 40,000. 6,000 into 100, 6 lakhs divided by 15, 40,000. So this 40,000 is the agreed value of debentures of B Limited. If we give them 40,000 of debentures in the new company, then 40,000's 15%, they will still continue to earn interest of 6,000. So what is the agreed value of A Limited's debentures? Instead of 1,20,000, 80,000. What is the agreed value of B Limited's debentures? Instead of 60,000, it's 40,000. Okay. This was the meaning of adjustment 1. Later on, how does it affect the accounting entries, etc. we'll see later on. Now let's come back to our first part. Okay. Which 3 things we have to decide in the question? Is it amalgamation in the nature of merger or purchase, method of purchase consideration, and accordingly pooling of interest method or purchase method of accounting. Now, what are the 3 conditions of merger? Condition 1. All the assets and liabilities must be taken over. Now here when they say A Limited and B Limited were amalgamated, a new company C Limited was formed to take over the business. This we have done earlier also. When they say business, it means all assets and liabilities are taken over. When they specifically mention business, all of you can refer to the explanation of the theoretical part done in this chapter in the lecture 1 and 2. When they say business, it means all assets and liabilities are taken over. Okay. So here particularly all assets and liabilities, first condition of merger gets satisfied. Second condition, at book value. All assets and liabilities must be taken at book value. Let us see that. Is land and buildings any different value given in the adjustment? No, means it's taken at book value. Okay. Is plant and machinery is any different value given in the question? No, means it is taken at book value. Investments also, no other value is given in the adjustment. Stock also, debtors also, and cash at bank always at book value only. It can never have different value. Now liabilities, which are the external liabilities? Debentures and creditors. Are debentures taken at 1,20,000 and 60 only? I repeat, are debentures taken at 1,20,000 and 60 only? No. Just now we did the adjustment. Debenture of A Limited's agreed value is 80,000 and debenture of B Limited's agreed value is 40,000. So are they taken at the same book value? No. What is the agreed value of debentures of A Limited? 80,000 and B Limited 60,000. So they are taken at agreed values. Creditors, no information is given, means they are taken at book value. However, debentures are not taken at book value. They are taken at agreed values. Instead of 1,20,000, 80,000, instead of 60,000, 40,000. So it is amalgamation in the nature of purchase. Second condition of merger is not satisfied. What is the second condition of merger? All assets and liabilities of transferor companies must be taken at book value. Here, which assets and liabilities, or which asset or liability is not taken at book value? Debentures. Debentures of 1,20,000 are taken at 80,000 and debentures of 60,000 are taken at 40,000. So it is not amalgamation in the nature of merger but rather purchase. Now once here itself it's confirmed that it is amalgamation in the nature of purchase, no need to check the third condition. It is already concluded that it is amalgamation in the nature of purchase. So let's go ahead. Which method of purchase consideration? Now there are three methods of purchase consideration. Number one, lump sum method. Of course, it's not lump sum method. Is the purchase consideration amount directly given to you? No. Second, net payment method. Here are the modes of payments given to you. Net payment method means what? All the modes of payments must be given. Nothing should be missing. Amounts should not be missing. If you see adjustment 2, what payment we are going to make to preference shareholders information is given. What payment we are going to make to equity shareholders is given in adjustment 3. So modes of payments and its details are given, nothing is missing, means it is net payment method. Which method of purchase consideration is there in this question? Net payment method. Okay, we are going to follow net payment method of purchase consideration because there are two modes of payments. Preference shareholders are given preference shares for which the details are given. Equity shareholders are given equity shares again for which the details are given. And keep it in mind, we discussed in net payment method that payment to only shareholders must be taken into consideration. So we will take adjustment 2 and 3 in consideration in net payment method, not adjustment 1. Adjustment 1 is a liability taken over, separate entry will be passed for that. But when we find purchase consideration, if you remember, we discussed that we should include payment made only to the shareholders. So adjustment 2 and 3 gives the information about the payment made to the shareholders, so that would be taken into consideration. Okay, that will make the working notes later on, but it is net payment method of purchase consideration. And third thing is to be decided only if accounting is asked in the books of transferee company. Which is the transferee company here? C Limited. Whose accounting is asked? Pass necessary journal entries in the books of C Limited and also prepare the balance sheet of C Limited. So we have to decide the third thing also. What accounting method we will follow in the books of transferee company, because it is not amalgamation in the nature of merger but rather purchase. Purchase method of accounting is going to be followed. Okay, so instead of that 7, 8 entries, one extra entry of statutory reserve will also come, that particular one. Before you see this lecture further, revise that entries. Go back to the summary and revise the entries in the books of transferee company. Okay, so number 1, it is amalgamation in the nature of purchase. Number 2, net payment method of purchase consideration is to be followed. And number 3, because it is purchase, we will be following purchase method of accounting. So let's proceed with the things further now. Now before we pass the journal entries, we will have to make workings and find purchase consideration for A Limited and B Limited. Because very first journal entry, okay, very first journal entry, business purchase account debit to A Limited, B Limited's liquidator, we have to pass with the amount of purchase consideration. So until we have the purchase consideration, we cannot proceed further. Okay, second workings we will be making for purchase consideration. Give the heading working note to purchase consideration. Now if you all remember, in the past lectures we have done a lot of practice of purchase consideration alone, so that will help you now. Okay, net asset method is also practiced in detail and net payment method is also practiced in detail. Give the heading purchase consideration in bracket, right, net payment method. Now again here I am explaining you the purchase consideration for A Limited, and all of you pause the video and try it on your own for B Limited. It is exactly similar. Okay, always do that, though I will be explaining in detail, but try on your own, then only the concepts will become clear. So first I am doing it for A Limited, and then you'll try on your own for B Limited. Okay, net payment method means we need modes of payment. So which are the two different modes of payment as we read in adjustment 2 and 3? As per adjustment 2, one mode of payment is preference shares, and the second mode of payment as per adjustment 3 is equity shares. First, let us find the value of preference shares. Okay, there are two modes of payment. First mode of payment is preference shares. Let's go back to adjustment 2 for this. Preference shareholders of two companies are issued equivalent number of 15% preference shares of C Limited. So we already discussed equivalent number means 6,000 preference shares will be given in A Limited, because present is 6 lakhs divided by 100, there are 6,000 preference shares. So in the new company also equivalent number means will be given 6,000 preference shares, but at a price of rupees 150 and face value is 100. So what would be the value of those preference shares? Number is directly given, 6,000. Okay, and 6,000, what is the percentage in the new company? 15%. So 6,000, 15% preference shares. Okay, 6,000, 15% preference shares of rupees 100 each (6,000) 15% preference shares of rupees 100 each and at rupees 150. 100 each but at rupees 150. 50 is premium we discussed. So 6,000 into 150. Okay, 6,000 into 150, 9 lakhs. What is the agreed value of the preference shares? 150. So how much are we going to pay in terms of preference shares to the other company? 9 lakhs. Now second mode of payment is equity shares. For that we will have to read adjustment number 3. So equity shares will have to read adjustment number 3. All of you see that in adjustment 3 what is it given? C Limited will issue, now for A Limited it is given 5 equity shares. From A Limited's point of view it is given, it will issue 5 equity shares for each equity share of A Limited. You take this second part first. For each equity share means for one equity share. For each equity share means for one equity share. In the new company you will get 5 equity shares. So make this columns. For one equity share, okay, for one equity share they are going to give 5 equity shares of C Limited. For one equity share of A Limited they are going to give 5 equity shares of C Limited. Now see at the top, how many equity shares are there in A Limited? 16,000, 16 lakhs divided by 100. Okay, 16,000 equity shares are there. So for one equity shares, if they give 5 equity shares, then for 16,000, okay, then for 16,000 equity shares, how many equity shares will be given? 16,000 into 5 divided by 1. How many equity shares would be given? 16,000 into 5 divided by 1. 80,000 equity shares would be given. Okay, 80,000 equity shares will be given. Now their value. See again adjustment 3. It is given, last sentence, the shares are to be issued at rupees 30 each, having a face value of rupees 10 per share. Okay, face value 10, 30, same like preference shares, face value 100 but agreed value 150. So here also 80,000 equity shares of rupees 10 each. Okay, of rupees 10 each but at rupees 30. So 20 is premium. We will multiply with 30. 80,000 into 30. Okay, 80,000 into 30, that is 24 lakhs. 80,000 equity shares and 30 rupees, that is 24 lakhs, plus 9 lakhs of preference shares. So what is the total amount we are going to pay to the liquidator of A Limited? 33 lakhs. Purchase consideration of A Limited company is 33 lakhs. Now exactly same way all of you find purchase consideration for B company on your own. Okay, pause the video, rewind it, understand for A limited again, and then same way all of you work out for B limited on your own. But try it on your own, okay? Okay, so first, again the two modes of payment are preference shares and equity shares. First mode of payment, preference shares. Now regarding preference shares, equivalent number. So equivalent number means, as we discussed in B limited there are 4,000 preference shares. So equivalent number means here it would be 4,000 preference shares. Okay, directly. 4,000 15% preference shares of rupees 100 each, but at rupees 150 each. So we will be multiplying with 150. 4,000 into 150, that would be 6 lakhs. Okay, 6 lakhs we will have to give to the preference shareholders. Now for equity shares, we will make that equation as we did for A limited. So equity shares for each equity share means one equity share in A limited. Now in adjustment it is given 4 equity shares are issued in C limited. To the B company, for each equity share 4 equity shares are issued to C limited by C limited. Okay, here you can see in B company for each equity share they are going to give 4 equity share for each equity share. So for one equity share in B limited, C will issue 4 equity shares, and see at the top how many equity shares are there? 15,000. In B limited there are 15,000 equity shares. So for 15,000 equity shares, how many will be issued? 15,000 into 4 divided by 1. 60,000 equity shares will be issued. Again, the face value is rupees 10, but agreed value is rupees 30. So we will be doing at rupees 10 of rupees 10, but at rupees 30 of rupees 10, but at rupees 30. So 60,000 into 30, 18 lakhs. Now 6 lakhs plus 18 lakhs. What is the purchase consideration for B limited? 24 lakhs. Okay. So if at all there is any confusion, I repeat, all of you must pause the video, rewind it, and understand it once again properly how to find a purchase consideration. Okay. So second thing we decided in the question, method of purchase consideration, it is net payment method. Now third thing, purchase method of accounting is to be followed. So what is to be done in purchase method of accounting, that we will see the workings in detail once we take up with the journal entries. Okay. All of you pause the video and make the format of journal entries in the books of C limited. Yes, so all of you should have done with the formats. So let us take up with the entries now. Okay. Very first entry will be for business purchase. So business comes in, debit what comes in, all of you write down business purchase account debit. And amount is payable to the liquidator. So credit the payable to liquidator of A limited account and to liquidator of B limited account. Now what amount is payable we have done in the working note 2. All of you can see that for A limited the purchase consideration is 33 lakhs and for B limited the purchase consideration is 24 lakhs. So liquidator of A limited 33 lakhs Liquidator of B Limited 24 lakhs, and business purchase account debit with 57 lakhs, being business of A Limited and B Limited purchased. All of you be careful that we are passing the entries by which method of accounting? Purchase method of accounting. Okay, so all of you can refer in the summary the purchase method of accounting's entries what I have made you write. Now second entry, what did I make you write in purchase method of accounting was assets account debit at agreed value, including fictitious, that is other non-current assets and current assets. All of you can refer that in the summary. To liabilities account, excluding assets account debit, excluding other non-current assets and other current assets, fictitious assets will not be included, and at agreed value. To liabilities account, excluding reserves. Statutory reserve is to be taken over, but for that separate journal entries to be passed. And again, liabilities at agreed value. And to business purchase account with the purchase consideration. Then we discussed in that summary, that in this portion, we have to find difference between purchase consideration and net assets. And that difference, if we are paying more purchase consideration, it is to be transferred to goodwill account. If we are paying less amount, we have to transfer to capital reserve account. So before we pass the second journal entry, first we will have to make this working note number 3. Okay, we'll have to first make the working note number 3 and identify that goodwill is there or capital reserve is there. Are we paying more or are we paying less? So third working note, all of you write down. First, A Limited, B Limited, and in fact you can combine it also, no need of A Limited and B Limited, directly we can write the total amount of assets and liabilities. First we'll find the difference between purchase consideration and net assets. So agreed value of assets taken over. Okay, first we will do agreed value of assets taken over So in agreed value of assets taken over, we'll take all the assets from the balance sheet. All of you can see land and building, they are taken at book value only. So 11 lakhs plus 8 lakhs, 19 lakhs. If we write down land and building, 19 lakhs. Then after land and building, we have plant and machinery, 7 lakhs plus 5 lakhs, 12 lakhs. Plant and machinery, 12 lakhs. Then after plant and machinery, we have investments, 3 lakhs plus 1 lakh, 4 lakhs. Then after investments, we have stock with 7 lakhs plus 5 lakhs, 12 lakhs. Stock, 12 lakhs. Then after stock, we have sundry debtors, 6 lakhs plus 7 lakh, 13 lakhs. Debtors, 13 lakhs. Then after debtors, we have cash and bank, 6 lakhs plus 4 lakhs, 10 lakhs. Cash and bank, 10 lakhs. So what is the total agreed value of assets taken over? Okay, 19, 31, 35, 47, 57, 60, 70. 70 lakhs is the agreed value of assets taken over. From that we'll minus agreed value of liabilities taken over. Okay, agreed value of liabilities taken over. Now there are only two liabilities. One is debenture and the other is sundry creditors. And debentures agreed value we have done in adjustment 1. Debentures 80,000 A limited, 40,000 B limited. So the agreed values are 1,20,000. So 10% debentures in old company, but their agreed values are 1,20,000. Then creditors. Now creditors agreed value 8,40,000 plus 3,80,000, so 12,20,000. Okay, creditors are 12,20,000. They are taken at book value itself. So total 13,40,000 is the agreed value of liabilities taken over. Now 70 lakhs minus 13,40,000, so 56,60,000 are the net assets taken over. Now, as we discussed in the summary, we have to compare net assets with purchase consideration. What the new company is getting is net assets of 56,60,000, and against that, what is the purchase consideration it is paying? 33 plus 24, 57 lakhs. Okay, 33 lakhs plus 24 lakhs, 57 lakhs. So, are we paying more or less? We are paying more. Against 56,60,000 we are paying 57 lakhs. How much more we are paying? 40,000 more. That is goodwill. Why we are paying more? For the reputation of the business, that is goodwill. If purchase consideration is less than the net assets acquired, then the amount paid less is our capital profit, so that would be treated and transferred to capital reserve. But here we are paying more. If we are paying more, it will be treated as goodwill. If we are paying less, it will be transferred to capital reserve. So why did we pass this? Why did we make this workings before passing entry number 2? Because goodwill account will also get debited in entry number 2. Okay. So now we will pass journal entry 2, assets account debit. Now assets account debit straight away you can take from this workings only, as we have done. Land and building with 19 lakhs. So in the second journal entry, assets account debit with agreed value, land and building account debit with 19 lakhs. Then after land and building, directly from the workings you can pass this second entry now. Plant and machinery account debit with 12 lakhs. So plant and machinery account debit with 12 lakhs. Then after plant and machinery, investments account debit with 4 lakhs. Then after investments, stock account debit with 12 lakhs. Then after stock, debtors account debit with 13 lakhs. Then after debtors, cash and bank or bank account debit. Okay, cash and bank account debit with 10 lakhs. Which one more account will you all debit? Goodwill. That's why we made this entire second working before you pass this entry. And this long working is required only if it is amalgamation in the nature of purchase. So goodwill account debit in bracket working note 3. Okay, goodwill account debit in bracket working note 3, 40,000. And then we take up with liabilities. So to 10% debentures account, but be careful that debentures we have to record at agreed value. Now we are doing purchase method of accounting, and in purchase method of accounting, wherever agreed values are available, we have to record agreed values. So agreed value of debentures, as we have done, 180 plus 40, 1,20,000. Okay, 10% debentures with agreed value of 1,20,000. Then after that, to sundry creditors account or to creditors account, all other assets and liabilities except debentures are taken at book value only. So creditors account with 12,20,000 and to business purchase account with the purchase consideration of 57 lakhs. Now all of you can cross check. Debit will be coming equal to credit. So 19, 31, 35, 47, 60, 70, 70 lakh 40,000 is debit side total, and credit side also 57, 69, 70 lakh 40,000. So debit total must be equal to credit total. Whenever you do this second journal entry, then just verify with this second entry, as it is a very lengthy entry. So there should not be any mistake in that. Being assets and liabilities of A Limited and B Limited taken over. Now third entry is for settlement of purchase consideration. So liquidator of A Limited is the receiver, debit the receiver. Liquidator of A Limited account debit with 33 lakhs. Liquidator of B Limited is the receiver, debit the receiver. Liquidator of B Limited account debit with 24 lakhs. All of you first write down this. Liquidator of A Limited account debit with 33 lakhs. Liquidator of B Limited account debit with 24 lakhs. Now, how are we paying this 57 lakhs? Look at working note 2, methods of payment. Preference shares. We are giving 6,000 preference shares to A Limited and 4,000 preference shares to B Limited. Okay, so to preference share capital account. To preference share capital account. Now here we will write preference share capital because the company is issuing the shares, so for them it is share capital. 6,000 to A Limited, 4,000 to B Limited, so 10,000 we are paying, and face value of preference shares is 100, so 10,000 into 100, 10 lakhs. Be careful, don't write 150. 150 is the agreed value and remaining 50 we have to transfer to premium. In share capital, what will go is face value only, that is 100 rupees. 50 rupees will go to premium, which we will combine later on. Okay. Same way, how many equity shares are issued? 80,000 equity shares are issued to A Limited and 60,000 equity shares are issued to B Limited. Face value is 10 rupees. So 80,000 plus 60,000, 1,40,000 equity shares are issued to equity share capital account. To equity share capital account, 1,40,000 total equity shares are issued to both the companies and face value is 10 rupees, so 14 lakhs. and now both equity and preference shares are issued at premium. So do security premium account. What premium? Preference shares are issued at 150 rupees, so 50 is premium, 10,000 into 50 plus. Equity shares are issued at 30 rupees, so 20 rupees is premium, so 1,40,000 into 20. I repeat, preference shares are issued at 150 rupees, so here the premium is 50 rupees, and equity shares are issued at 30 rupees against 10, so here the premium is 20 rupees. We have marked this in adjustments also. Here you all can see we have marked 50 rupees of premium, 20 rupees of premium. So same 10,000 shares into 50. 5 lakhs is security premium of preference shares plus 1,40,000 into 20. 28 lakhs is the premium of equity shares. 33 lakhs is the amount going to be transferred to security premium. And you can again cross check. 33 plus 10 plus 14 is equal to 57 lakhs, and here also 57 lakhs. So third entry is also very important here. All of you have to see the amounts carefully, which you get from the workings of net payment method only. Okay, preference shares 6,000 plus 4,000, 10,000 into 100 rupees of face value, 10 lakhs. Equity shares 80,000 plus 60,000, 1,40,000 into 10 rupees of face value, 14 lakhs. And both preference shares and equity shares are having premium. In preference shares 50 rupees is premium, so 10,000 into 50. In equity shares 30 rupees is the agreed value, means 20 is the premium, so 1,40,000 into 20. Okay, being purchase consideration settled. Being purchase consideration settled. Now, fourth entry. Fourth entry we discussed for public issue, but do we have any public issue over here? See adjustment 1, 2, 3, 4. Any shares issued in public? No. So fourth entry of public issue is not there. Fifth entry, liquidation expenses. They are also not given in the question. Liquidation expenses of A Limited and B Limited paid by C Limited are not given in this question. So fifth entry also not there. Sixth entry, establishment expenses. They are also not given. Any incorporation, preliminary registration expenses not given in the question. Okay, 4, 5, 6 entries are not to be passed. Now directly seventh entry, settlement of liabilities. Here you all can see 10% debentures. We are giving them 15% debentures, and we have already done the calculations for that also. So old debentures liabilities 10% we have to close and debit. This 10% debentures account, which was it agreed value of 1,20,000, we have to close and debit. 10% debentures account debit with the agreed value of 1,20,000. Okay, you have to close that with the same value what you credited in the second entry, 1,20,000. And against that, we are giving them 15% debentures of rupees 1,20,000. Okay, against that, we are giving them 15% debentures of 1,20,000. Being 15% debentures issued to debenture holders. Okay, being 15% debentures issued to debenture holders. So all the entries are passed in the books of transferee company. The total of journal 57 lakhs plus, well, if we can do it, 57 lakhs plus 19 lakhs plus 12 lakhs plus 4 lakhs plus 12 lakhs plus 13 lakhs plus 10 lakhs plus 40,000 plus again 57 lakhs plus 1,20,000. So 1 crore 85 lakh 60,000 is the total of journal. Okay, 1 crore 85 lakh 60,000. Now, journal entries are all done. So as we have been doing earlier, all of you make a blank format of balance sheet and leave one page for that, and after that we'll make the notes. So all of you make the blank format of balance sheet. We make the notes for the balance sheet first. Okay. Leave one page for the balance sheet. First we'll make its notes. Then we'll do fill in the blanks in the balance sheet. So first note is share capital. Now share capital is authorized capital given in the question. All of you can see it's not given. So straight away authorized capital will write question mark and double underline. This I have told you in past lectures also. So authorized capital question mark and double underline. Then issued, subscribed and paid up capital, straight away we will have issued, subscribed and paid up capital. Now this we will get from entry number 3. Okay, as we have already done the net gist in entry number 3. Here, how many preference shares are issued? 10,000. So straight away from entry number 3 you will write in issued, subscribed and paid up capital 10,000, 15% preference shares of rupees 100 each. 10,000, 15% preference shares of rupees 100 each, that is 10 lakhs. Then from the same journal entry 3, all of you can get the equity shares also. 1,40,000 equity shares of 10 each, that is 14 lakhs. Okay, 1,40,000 equity shares of rupees 10 each. That is 14 lakhs. Now both of these are issued for consideration other than cash. So you'll just mention all above shares are issued to A Limited and B Limited for consideration other than cash. Okay, total 10 lakhs plus 14 lakhs, 24 lakhs. 10 lakhs plus 14 lakhs, 24 lakhs is the share capital. Now second note will be for reserves and surplus. Oh, I'm extremely sorry, but one journal entry we all have forgotten. As I came across this reserves and surplus, I recollect this. Okay, we discussed that this 18 lakh 56, 1 crore 85 lakh 60,000 will keep in mind. This can help in further total. We discussed that statutory reserve is to be taken by the help of other journal entry. Fourth adjustment, export profit reserve is to be maintained for next 5 years as a statutory reserve. For that this extra journal entry will come, amalgamation adjustment account debit. Okay, amalgamation adjustment account debit to statutory reserve. Here it is the statutory reserve, export profit reserve account. Amalgamation adjustment account debit to export profit reserve account. And what is the amount of export profit reserve in the balance sheet? 1 lakh of A Limited, 1 lakh of B Limited, so total 2 lakhs. Okay, 1 lakh of A Limited plus 1 lakh of B Limited, total 2 lakhs being export profit reserve taken over. Okay, it's a statutory reserve which we have to take over. So being export profit reserve taken over. Now we already got total of 1 crore 89 lakh 60,000 plus in that we'll add 2 lakhs, so 1 crore 91 lakh 60,000. Now this reserves and surplus, what all will come, understand this. Very first of all, in adjustment, second entry we don't have any reserves and surplus taken over because liabilities don't include reserve except statutory reserve. So one is this security premium of 33 lakhs which will come in reserves and surplus, and the other is this export profit reserve of 2 lakhs. Okay, two items will be there in reserves and surplus. Note number 2, security premium of 33 lakhs plus export profit reserve of 2 lakhs. So total reserves and surplus will be 35 lakhs. Now third, after reserves and surplus we have long-term borrowings. Third note is long-term borrowings. Now in this long-term borrowings we have in the new company this 15% debentures. In the long-term borrowings what we have is this 15% debentures of rupees 1,20,000. 10% debentures account is already getting closed. So now in the new company instead of 10% we are going to pay 15% and the agreed value is 1,20,000. So here 15% debentures and agreed value, all of you write down 1,20,000. Okay, non-current liabilities. Now in current liabilities we have trade payables, that is creditors. So in the journal entry all of you can see creditors are what amount? Creditors are 12,20,000. Okay, so creditors 12,20,000. Then after creditors we don't have any other current liabilities. Okay, current liabilities like short-term borrowings, short-term provisions, other current liabilities we don't have. So straight away we go to assets. In assets, non-current assets, in that fixed assets, in that tangible fixed assets. So very first we will have tangible fixed assets. Now what all do we have in tangible fixed assets? See entry number 2. Land and building of 19 lakhs and plant and machinery of 12 lakhs. Okay, land and building of 19 lakhs and plant and machinery of 12 lakhs. Total 31 lakhs. Then after tangible fixed assets we have intangible fixed assets. Now in intangible fixed assets we have only goodwill. Okay, in intangible fixed assets all of you can see in the second entry goodwill account, that working note what we had done 40,000. So in intangible fixed assets goodwill will come with 40,000. Then after intangible fixed assets we have non-current investments. So investments we do have in second entry. In non-current investments, we'll have this investments of rupees 4 lakhs. Okay, investments 4 lakhs. Then after non-current investments, we don't have other non-current assets in long-term loans and advances. We go to current assets. We don't have current investments. Straight away in current assets, we have inventories. Inventories will include stock. So stock we have with rupees 12 lakhs. Okay, in inventories, we will have stock of 12 lakhs. All we get from the second journal entry major. All amounts majorly we will get from second entry only. Then after inventories, we have trade receivables. So in trade receivables, we will have debtors and bills receivable. Here in second entry, we have only debtors. So from second entry, all of you can see debtors are 13 lakhs. Okay, debtors 13 lakhs. Total also 13 lakhs. Then after trade receivables, we have cash and cash equivalents. Now cash and cash equivalents, so here you have to be careful regarding the amounts. You all can see in the journal entry 2, cash in bank account is 10 lakh rupees debited. Then other than that, we don't have any amounts, no payment of expenses, etc. is there. So in this question, this 10 lakhs will come as it is. Okay, cash and bank 10 lakhs. If any expenses, etc. are paid, any public issue is there, then those amounts are to be added and subtracted. But here we don't have it, so directly 10 lakhs. Then short-term loans and advances and other current assets we don't have. Now all of you will make the balance sheet and do fill in the blanks in that. So I'm showing it to you. My balance sheet is already ready. See here, in balance sheet, equity and liabilities, shareholders funds, share capital as per note 1, as we have done 24 lakhs. That will come over here. Reserves and surplus as per note 2, we have done 35 lakhs. That will come here. So shareholders funds 59 lakhs. In non-current liabilities, long-term borrowings as we have done in note 3, 1,20,000. That will come here. In current liabilities, short-term borrowings nil. Trade payables as we have done in note 4, we have 12,20,000. That will come here. Then short-term provisions, other current liabilities we don't have. Total of liabilities 72,40,000. Asset side, non-current assets, fixed assets. In that tangible fixed assets we have done in note 5. You all can see here 31 lakhs. That will come in the balance sheet. Intangible fixed assets, that goodwill is there of 40,000. Note 6. That will come in the balance sheet. Non-current investments as per note 7, you all can see 4 lakhs. That will come in the balance sheet. Then other non-current assets and long-term loans and advances we don't have. Okay, in this other non-current assets, this 2 lakhs is of amalgamation adjustment account. So that will come over here. Other non-current assets will come after non-current investments. Okay, we have seen that in this entries that this amalgamation adjustment account we show in other non-current assets, and statutory reserve we show in reserves and surplus. So in this question, this amalgamation adjustment will come as note number 8 in other non-current assets. If you have already written it, then you can write this other non-current assets note at the end and just change the number of other notes. So this will come as amalgamation adjustment account. Okay, here amalgamation adjustment account. In that we have 2 lakh rupees. In the last journal entry, you all can see we recorded amalgamation adjustment to export profit reserve. Other notes numbers will simply change. So you can write that as a last note and just change the note numbers. It will become 9, 10 and 11. So note number 8, other non-current assets, we have here amalgamation adjustment of 2 lakhs. Total non-current assets 37 lakh 40,000. In current assets, current investments we don't have. Inventories as per note 9 we have 12 lakhs. Then debtors, that is trade receivables, as per note 10 we have 13 lakhs, and cash and cash equivalents as per note 11 we have 10 lakhs. Other short-term loans and advances and other current assets we don't have, total 35 lakhs. So again here the total comes to 72 lakh 40,000. So all of you can pause the video and make this balance sheet. Okay, I repeat, all of you can pause the video and make this balance sheet. You just have to make it from the notes itself. So you can pause the video and make this balance sheet, right? Now question 7, next one is similar to this. So all of you try on your own. In question 7 only balance sheet is asked in the question. Mind well, only this balance sheet is asked. Means directly you can make the balance sheet without passing the journal entries also, that's okay. So you people try that balance sheet directly, and if you're not able to make it, then you pass these journal entries and then you do the balance sheet. For practice, all of you may do this journal entries also. Okay, so that will be all in the today's lecture. In next lecture, we'll go step by step, increasing the complications and levels. Okay, bye everyone, take care, see you in the next lecture.